What's going on, everybody? What's good? What's good? We are live and ready to go. Let me just type my little post in here. What's going on, everybody? What's good? What's good? Live and ready to go. All right, so I hope you don't have any feedback. Please let me know if there is feedback at all. I am streaming on YouTube as well right now, and so there's, I got a screen in front of me. So if it gives any feedback, just maybe just type in the chat, feedback or echo or anything like that. How's everybody's weekend going? How's everybody's week going so far? Blessed. I love it. I love it. Love it. Love it. Edward Daffin was good. Nabila was good. Let's go. John Carigliano. That's a cool name, man. That's got to be Italian. That's got to be Italian. Langston in the house. What's going on? What's going on? So I decided I wanted to kind of give back a little bit tonight. We're streaming live on YouTube, and I posted the link to class. So if anybody's gonna join, I just wanted to open it up to whoever, and I'm gonna do my best to follow the chat on YouTube. But to be honest with you, I'm gonna be more so focused on the chat for TGP. So if I don't see something on YouTube, forgive me, but I just wanting to make sure you guys get an opportunity to be in class. And man, we're gonna have a good class tonight. It's gonna be a good time. So I need to see at least like a couple of ones or something. I need to see some. I need to see if people are ready. All right, we got some people ready then. Let's go. Man, we're gonna get it in tonight too. We're gonna have a good class. Just move my notes over here. Move my notes over here where I can see them. And yeah, we good to go. Why is this thing not letting me make it smaller? Hang on 1 second. All right, so we're gonna get into it. We're gonna get into it. So first off, let me just say, if you are watching on YouTube or if you are not a member of TGP and you happen to be in class tonight, welcome. Glad you're here. And just wanted to kind of, take this little time before Thanksgiving and give back a little bit. So give everybody an opportunity to be in a class and learn something. Hopefully can add some hopefully we can add some value and some knowledge to your trading and help you get it in, man. So I'd love to see you win and grow. And man, please comment, in the YouTube, or not only just in YouTube, but man, send me a message on my Facebook or Instagram on the Trading Get Paid page. Send it, like, make a little post on the page and let people know the value that you get. I want to make sure that everybody knows what we're doing over here, man. It's not your standard stuff that's going on over here. We're teaching some really good deep principles, and so I want to help everybody. Excuse me. So Yeah, we're gonna get it in. Gonna get it in. Who was here in class last week? And as you guys are commenting that in the TGP class, let me just tell everybody else, if you want to be part of the class every single week, I mean, look, we're killing it. Like, these classes are fire. So if you want to be in these classes, join up. I don't know, I know some of you are watching from YouTube, you're watching from Instagram, you're watching from Facebook, whatever. But man, join the team. Somebody from TGP comment, and let these people know what time it is. Like, do they need to be in class with us, or we're just wasting time out here? What's going on? Yeah. My camera wasn't working last week, but the screen was working though. Yeah. So yeah, if you feel like people need to be in class, man, just drop a little comment and let them know. Let them know, because I know the value that's coming in here is next level. And forgive my voice, it's been a rough couple weeks. I haven't been feeling real good. This past week's been a little bit better, but the last couple days, actually, I've been kind of feeling sick again. So I'm hoping that we kick this thing, but finally. But so, man, forgive my voice. Shout out real quick to Skylar. Skylar, you on with me, bro?
Yes, sir. I'm on here.
Hey. So Skylar is helping moderate the class. So I don't know. I'm sure you probably already seen. I know you hopped on here. We are streaming on YouTube. There's people here tonight that are not necessarily part of TGP. We opened it up for everybody else. And so, Skylar's gonna be excuse me, Skylar's gonna be moderating the TGP side of this and helping me make sure I don't miss any questions. And I'm going to do my best to make sure I stay on top of YouTube and check that out too. And, I want to make sure that people are getting the value that they want. So, yeah. So anybody has a question, please post it. I want to make sure I'm giving you the value that you need. And we're going to cover some really good stuff tonight. So who's ready to jump on these charts? Who's ready to actually jump on these charts? And let's get it. Now, I will say real quick, YouTube is a few seconds behind. So if you see me like looking down like this, so let me just like look at my camera, right? My camera is here. My charts are here. My YouTube is here. And my notes are way over here. So if you see me like looking down and I'm just kind of waiting, it's probably because I'm looking at something on YouTube and maybe answering a question or something. And there's some, they're a little bit behind us. So I'm doing my best to just kind of help everybody. All right, here we go. Let's jump on these charts. Hang on a second. I don't know what just happened here. There we go. There we go. Now we're cooking. All right. To move my stuff around so I can see. Make sure you guys are good. And we are getting to it now. All right. So we're going to start with these little candles right here. I'm going to kind of give a little bit of recap where we left off last week. If you were not in class last week, I need you to go back and watch that video. All right. Because I'm not going to go over every little thing that we went over last week. But I do want to make sure that at least everybody's kind of caught up on the same page. So if you did not watch class last week yet, please go back in the resources in the trading courses section in the recordable content, the most recent class from last week. and it's talking about fair value gaps and Forex Imbalance. So you can watch that whole class last week and watch it now and kind of catch up, if fill in the gaps for what maybe you might be missing for tonight. But I am going to give a quick little recap. So how many people here, whether you're here and you were not here last week, or whether you're watching on YouTube or something like that, how many people here know and understand what fair value gaps are, or hidden gaps, as some people call them? How many people understand what that is? Just put a little comment, say yes or say no in the comment if you understand or don't understand what those are. Awesome. All right, cool. And if this is your first time in class tonight, welcome, man. If you're a TGP member and you're brand new, welcome to the team, man. Let's get it. All right, so we got some people who don't know, and we got a few that do. Somebody on YouTube said they know, so I'm doing my best to kind of watch there as well. Awesome. So check this out. Here's what we're gonna do. First things first. Let me grab my annotation right here. When we are looking at fair value gaps, really what's happening is price is moving in a certain direction, right? And then what happens is at some point either we catch a reversal or we get a continuation, maybe after a pullback. And what happens is instead of having like, if this is a continuation, instead of having candles that just continue up, like candle here, candle here, candle here, everybody's good, normal sequence, what happens is you get a gap. Now, somebody tell me on my screen which one of these is a fair value gap and which one of these is not. Left or right? Which one of these is a fair value gap and which one of these is not? All right, so we got most people saying left. All right. Yeah, so we got left side. All right, awesome. So whoever said left, you were right. If you said left, you are right. All right. So no pun intended. If you are left, you are right. If you are left, you are correct. All right. So here's what happens. Normally, yeah, Skylar, I like that. Get right or get left. Normally what happens is every time, and I'm not going to get too deep into this part of it, but every time we see a time period close, we always have to remember that there are waves inside of waves. Now, if you're in TGP class and you're here, you have heard me say this ad nauseum, right? You have heard me say this a million times because wave theory is so powerful. If you are looking at a move on, let's say, the 4-hour chart, well, on the 30-minute chart, you're going to see that move has waves inside of it, right? And so that's how it would look on a 30-minute chart. And then that same thing on, let's say, a 5-minute chart, right? It would be just crazy. It would be like a lot of moves in here and then a lot of moves, it would be just a lot of moves going on, a lot of noise, as some people say. Wave theory, or understanding multiple time frame analysis, is very important, because when we do our top-down analysis and we start from, let's say, the 4-hour, but we don't trade until we get to like the 15-minute chart, well, then we need to understand the correlation between the two. We need to understand how they work together. Now, I say all that to say that's important because every time one of the time frames closes, it cycles. Okay, we have what we call currency cycling. And so every time, so if you see this move happen here, and that's an extension on, let's say, the 4-hour. Now, mind you, on that 30-minute, we've already seen, it move up, move down, move up, move down, move back up. And what that might have only been one candle on a 4-hour. We see a whole trend on a 30-minute chart, but on the 4-hour, that might only be just one candle with a wick on the bottom or something, And so what we need to understand is that when that is happening, when we see that 4-hour candle coming, or that 4-hour trend or candle or whatever it is coming to a close, well, guess what? That 30-minute cycle has got to either agree with it, it's going to run with it, or we're going to create a divergence where the 30-minute is pushing down and the 4-hour is pushing up. Now, all of that is very important, because when we see agreement in the market, when we see that the 4-hour is trending up, we see that the 30-minute is closing with an uptrend, the 1 hour, the 15, all of this stuff, we see all of these time frames that are working in agreement with one another, then we know we have strong direction. When we start to see that they disagree, maybe the 4-hour is trending up, but the 30-minute is trending down, what we're really saying is that we're in a cycle. And likely on that 4-hour candle, you're starting to see a wick. You're starting to see it pull down a little bit before it goes and pushes back up. Because you're never going to get 4 hours, 8 hours, 1 day, 1 week, 1 month, these big, these bigger time frames. You're never going to get where it just moves in one direction and never has any opposite direction momentum. You're going to see ebbs and flows in the market, and that's healthy for the market. If price continues to move up without any resistance, well, what happens is, how can people buy, right? It's like the housing market. If we have a house, you got to love my beautiful house here, right? If you have a house, let me put a window in it. All right, there we go. If we have a house and the price of housing is going up, 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 well, the people that could afford to buy down here probably can't afford to buy here. And so if price continues to go up, 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 people that could still afford to buy here probably can't afford to buy here. And then if it continues to go up, 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 people that you see what I'm saying? At some point, you've got to have some correction to the market, or else you're pricing your buyers out. You're not allowing your buyers to get a position that works for them. So what happens is price continues up, and in order for the strength of this move to continue up, we need a correction. We need it to pull back so that the buyers have another opportunity to take it up even more. And then it comes back down and allows buyers to come back in and corrects again or extends again, and so on and so forth. This is how a healthy market moves. Okay. Now, every time you see extension, correction, this correction area, that's the cycle. That's what's happening, is you're seeing currency cycling. You're seeing where, if you were looking at a currency strength indicator or the currency heat wave app, if you were looking at something like that, what you would actually be seeing is you would be seeing on this, we're looking at AJ right here in this chart. So Aussie dollar would be strong and yen would be weak. Okay. Now, when you get to this point, it's going to start changing when you get here, and you're going to see Aussie dollar start to lose strength and Japanese yen start to gain strength. That is called a cycle. That doesn't mean that the trend is reversing. That doesn't mean that the move is over. That doesn't mean that like we're done. It just means that there's a cycle happening in the market, and we're getting in position for another extension. And when that happens, we see a correction come into the market. When we see that correction, buyers get back into the market and push the market back up again. Now we see on that currency strength indicator or anything like that, we see Aussie dollar strong again and yen weak again. And this happens over and over in the market until finally the trend is over and we see an actual reversal. And at that point, we see the Aussie dollar get weak, the yen get stronger, and we see a reversal in trend. And now we see a down move. That is how the market moves. All right. So I say all that to say this. Every market, remember this, write this down, take this note. Every market has its own sentiment, its own fundamentals. Technicals, what most of us trade is technical analysis. Technicals are what we see on the chart, but technicals are not caused by technicals. Many people are out there teaching that, you know, like when this dot does this and when this line crosses this or whatever, when this hits this pivot, none of that's wrong. It's all good. There's nothing wrong with these indicators. There's a reason why they're there. Okay. But what I'm saying is technicals are not created because of technicals. All right. Technicals are not there because technicals cause them to happen. Right. It's the fundamentals and it's the sentiment that cause the technicals to happen. So it's good to know technicals, and we need to know that. Technical analysis is strong. We need to know that. But we also need to know why. All right. And that's what separates this class from everything else that's out there. Because we don't just talk about what's happening, we talk about why it's happening. All right. And so, yeah, exactly. Abdullah, I hope I say your name right. Price does not move price. That's a great way to say that. So what I'm saying is, it is the fundamentals and it is the sentiment that moves the market. And what we see play out in price action is a result of those things. Interest rates that come in the market, investment money that's in the market, banks that are moving money, and most of all, supply and demand, orders being filled in the market. When orders are being filled, that is the number one driver of the market in any direction. Secondly, after that is your interest rates. When you have interest rates, if there are, let's just say, for an example, that there are no orders, all right, which never happens. But if there was not one order to fill in the entire market, all right, what would be moving the market would be the interest rates. It would be investors investing into the market at certain interest rates, letting their money come in and out of the market. But the big thing that moves the market, it's the orders that are being filled. It's when you see that there are buyers and that there are sellers, and those buyers and sellers are moving money back and forth, filling orders, gathering liquidity, gathering orders, and meeting the money to the order. The need or the demand, excuse me, to the supply. And that is what moves the market. Hang on one second, I gotta get a drink. So, does that make sense to everybody so far? Drop a 1 in the comments if that makes sense to you so far. Awesome. So now that we have that, so let's talk about these gaps. All right. Every market, and I want you to really take this note, every market has its own culture. I guess that's a good word. Environment, atmosphere. Every single market has its own character, if you would. All right. For an example, how many have ever traded the CHF currency before? Put a 1 if you've traded CHF. Not a lot of people in TGP are going to do that because I'll be driving you guys away from CHF. Skylar put a 0. I love it. I love it. I tell people to stay away from CHF. Now, I'm not saying it's not a bad currency at all. It's actually a pretty steady currency as far as what it does. But CHF, if you'll look at a chart with, like, for example, GBP CHF or something like that, right? You will see that there are lots of big wicks. And what happens is those cycles happen fast. Very, very fast cycles. When it'll push up, push down, push up, push down, push up, push down. And then it'll be like spike up, like it's crazy, right? CHF is a tough currency to trade because it is high volatility. All right. It's not a lot of volume, it's a lot of volatility. And there's the difference, which I'm not going to get into tonight. So CHF has its own kind of character and how it moves. Aussie dollar has its own character. US dollar has its own character. GBP has its own character, so on and so forth. CAD, Euro. Some of them match up pretty well. Euro and USD kind of move very similarly, right? Not necessarily in the same direction, but the same character, like the same way it moves, same type of patterns and things like that. CAD and Euro, same thing. It moves very similarly, right? Not necessarily in the same direction, but the same patterns and the same way it moves. Whereas NZD moves very differently than like CAD, right? NZD is fast, boom. But once it catches a direction, it moves with heavy volume. GBP is a heavy volume currency, right? So I'm saying that every pair or every currency has its own character. I'm saying all of that so you can get this part. When there is an established market character, trend, culture, however you want to word it, that culture, that character, that environment becomes the norm. That is called market sentiment. We think market sentiment is just which way the market is moving. Well, there's no difference between that and trend, right? What is the difference between a market trend versus a market sentiment? A market trend just says like this. If I ask you right now, what is this right here? Is this low, high, higher low, higher high, higher low, higher high, higher low? What is this? This is what kind of trend? Real simple, beginner class. Right, it's a bullish trend, an uptrend, right? So we see an uptrend here. However, what is the difference between that versus market sentiment? So market sentiment means we have a bullish sentiment? Well, no, not necessarily. Sentiment is more involved and more detailed than just simple trend. See, market trend says higher lows and higher highs tell us a trend. However, market sentiment tells us a full extension in the current sentiment, the current atmosphere, the current environment, the current existence of this market. The current extensions right now in this market is that the bulls are typically moving at this velocity, this volume, this many orders, this much money, this much strength. And our current pullbacks on average are, let's just say, 45% pullbacks is what we're seeing normally right now, right? We're seeing, yeah, I like that, Nick. It's a whole vibe, yeah. So a sentiment doesn't just tell us if it's bullish or bearish. A sentiment analysis tells us this is the current uptick and this is what the current pullbacks look like. Current pullbacks are, let's just say, 45%. And then we get another similar extension as to what we had before. And then another similar retracement as before. And then another similar extension as before. And then another similar retracement as before. Does that make sense to everybody so far? Because this is the current condition, or as Nick Jones has now TGP stamped it, the whole vibe, right? This is the whole vibe of the market. We're seeing, 80% extensions, 45% retracements. We're seeing that the bears are in control by a 40% margin. We are seeing that the overall volume of the market is this many orders or this much volume, currency volume. It's more than just saying it's bullish or bearish. All right. So I say all of that to say this. This is where we get into the gap. All right. Let's say that currency is cycling and the normal rate in the current environment, the current vibe, Nick Jones, the current sentiment, the current atmosphere, the current character of the market is that we are getting extensions and corrections. And what's happening is every time the currency cycles, we're having it cycle on every time period. We are seeing the time period cycle on every 30 minute, on every 30 minute, on every 30 minute. We're seeing it cycle. We're seeing that we have, let's just say, in PIP language, let's bring it down to PIP language, all right? What we're seeing is that on typical ATR, average true range, we're seeing an extension of, 20 pips and a retracement of 8 pips. So really what we're saying is we're seeing about a 45 or 40% retracement, something like that. And that is the current character of the market. So if that were to continue to take place, we would see an extension, a correction, an extension, a correction, an extension, a correction, an extension, a correction. Does everybody understand so far? This is basics. All right. But then all of a sudden, what happens is in the middle of what we see as a normal market culture, character, vibe, whatever you want to call it, in the middle of this, we suddenly see where there is this big move. And that move is not normal for this current market. That move is different than what we've been seeing on the regular. All right. So now we are starting to say, many of us, we get caught in that. We go, oh, bullish, bullish, bullish. That's it. Strength is in the market. Get in, get in, get in. And we get in right here. And we're like, look, we're already way too late. Look at this. And then we wonder why we're losing trades. We see one big move and we just jump all in and we're like, oh, man. And then we wonder why we lose. What we need to do is we need to understand why this happens. What's happening is that one of two things is possible. One is the current move is over. You say, well, if the uptrend is over, wouldn't it move down? Right? Yes, but not before the banks make their last little bit of money. This is called market manipulation. So either one of two things is happening. The current market trend is over and we are about to see a downtrend. And before we see that downtrend, they are not going to sell here if they can sell here. Why would you sell for $1 if you could sell for $1.20? Right? Any smart businessman will tell you that if you can sell for a higher price, you should sell for a higher price. Right? Skylar, if you told me you were selling your house for $200,000 and I came in and I said to you, I'll make you 2 offers, you pick one. I'll buy this house from you for $200,000, or I'll buy this house from you for $250,000. Which one are you going to pick?
250 all day.
It ain't that difficult, is it? We would sell the house at the higher price. Now, Skylar was going to give me a deal because he's my homie and stuff, but we would not sell the house at the lower price. We would sell the house at the higher price. Any smart person would do that. That is what is happening here. Yes, there's about to be a down move, but they're going to get their last little bit of money before that change happens. Now, sometimes it's not that there's a change in direction happening. It's that there is what we call reaccumulation or redistribution in the market. It's when there's supply and demand, but the original gather was not enough. Okay. And so what happens is there's demand in the market. So the market's moving up. But as we started to gather the supply, there was more demand that was there. And so we have to gather, there has to be liquidity involved. And what happens is another push comes up to let the sellers know where we are. It comes back down to retest a certain area and then pushes back up. And this area where the demand was down here will start another demand at this higher level, giving us another buy opportunity for the buyers to get in. Does that make sense to everybody so far? When that happens, either one of those happen, many times what we're going to see is an abnormality, where in the normal market, a candle closes, a new one opens, a new one closes, and then the next one comes and retests that right back to that previous area, because every order is being accounted for. Every dollar is being accounted for. Everything is happening to make everything work together in a current rhythm, in a current character of the market. The vibe of the market is that we are going to close our orders and move to the next one. Close our orders, move to the right. But then all of a sudden, in the midst of what we see as a normal market, something like this happens. And in this market, a candle closes, another big move happens, and then this time, this does not come down and retest this area. So what we have is a gap. Now, when we see that gap, we should not just automatically say, that's it, big blue candle, jump in, buy, forget everything else. No, we should treat this like any other gap, like when the weekend market gaps, like when there's a supply and demand in the market, when there's a base in the market. We should always find that gap, grab our box, and box it up. Just like that. We should go from when this candle pushes up and the next one does not come back and close back down to this candle, or I'm sorry, where the wick like this does not at least come back to that candle where you have that gap. We should box it up. And what is going to happen in most cases is you are going to see either one of two things happen. Okay? Either the next candle is going to come and close that, right? Before the next push up. That is when we call closed or satisfied orders. Now, remember, guys, do you remember last week in the class, I told you I'm going to talk about satisfied orders versus batched orders. Remember that? Like I said that last week? That's what we're going to talk about right now. All right. When orders are satisfied, in other words, this gap happens in the market and the orders from this gap are satisfied. We're done. We created the gap. There was this demand in the market and the orders are satisfied. We have an even number when it comes to demand versus the orders that we needed, the supply that was there. And so what happens is we get a big push down right back into this area. It closes the gap. It will push back up and give us probably what looks like, one of these kind of candles. And then price will rise up from there and break past this area to create our higher high. That is when orders are satisfied. However, sometimes the orders are not satisfied. And what happens, let me bring this down just a little bit. What happens is price says, wait a minute, we created this demand here. there's this gap, this fair value gap. In other words, the buyers are showing that in the current market, the buyers just made a push and took strength. It's like that, football team is going back and forth, back and forth. There's this game on the field going back and forth. And finally, the one team says, you know what, enough is enough. We're going to pull out the big guns, and they do some trick play, or they, and they go ahead and they take the momentum. They take the game, right? Like what Michigan's going to do this weekend to Ohio State. So you have this control is taken by the in this case, it would be the bulls, the buyers. Now we can do one of two things. We can come and fill this order and go up and satisfy those orders. Or sometimes what you see is that it just goes. It just starts going, and we never fill that gap. It just takes off on us, and the gap is never filled. Now, why does that happen? It's because, do you think that the banks stop communicating and stop, talking about business just because this happens? No. Once the buyers make this move happen and there's this gap in the market, the banks are still talking. Orders are still coming in. There is still investments. There is still a lot of money moving around, over $6 trillion a day. So if we're talking about, let's say, GBP, which is about 20% of the market, you're talking about, over $1 billion. You're talking about over $1 billion in currency. So we see this happen. That doesn't mean that the gap isn't going to get filled. That just means that the buyers are taking up, and they're going to go ahead and they're going to dump off what they have, and the remaining orders from this gap, from the value of where the agreement was made, that's really all a fair value gap is. It's just an agreement made of a price. We agree at this price, we're going to do business. But the buyers say, wait a minute, yes, we're going to do business here. We confirm that. We're going to do business here. But you're not the only one we're doing business with. And so the buyers continue to go out and gather more orders. And there's more stuff out there. There's more supply out there. And there's still negotiation out there. So what happens is you see the market come up, and then all of a sudden you'll see, boom, a big, strong move come down. Now, typically that's not going to be the 15-minute chart, the 5-minute chart. It can happen, but typically this is going to be the 1-hour chart, the 4-hour chart. It's going to be the bigger time frames. Those time frames, because there are, in the more time you take, there are more orders to process. Those orders are going to come out, and then there's going to be a big move that pushes us back into that area so that we can satisfy or close those orders. Once those orders are closed, then that's where we come in here and we say, is there demand in the market? And if the demand in the market is stronger than the supply in the market, if the sentiment continues after this big push from here, that's when you're going to see a beautiful, beautiful trade with a high reward, low risk type setup. It is in that moment when you see price coming back into here and then breaking out past our box, that move that takes us out of the box. That is where we are going to want to get in here, grab our tool, and we're going to come behind our entry area, 1.5 times our entry, and then we're going to come back up here, up to our previous high, because in order for, it all comes back to technicals, right? At some point, what's going to happen, let me grab this annotation. At some point, what's going to happen is you're going to see low, high, higher, low, and we're going to have to at least come up and try to test this higher high in order to see if this price is going to move past here and continue in an uptrend, or is it going to reject there and see us start a downtrend. But at minimum, we think we're going to get into this area here. And so that is what we do. We get in here, we do a 1 0.5 or a 2 times ATR, or you can use your entry candle. If you have like an engulfing candle, measure that candle. If that candle is 20 pips on a 1 hour chart, let's say, or if you're on a 15-minute chart and that candle is 8 pips, go 8 times 2, use a 16 pip stop loss. 8 times 1.5, maybe if you're a scalper, do a 12 pip stop loss. And then you come up here to the previous structure and run that trade right back up to the top. Trail your stop loss behind it to secure the bag all the way back up. And the closer you get to the top, the more money you should be taking out of the market. Does that make sense to everybody so far? Now, let me say one thing, all right? Because I just want to be fair. We have a lot of people out here who and I'm not dogging them, all right? Because there's a lot of really good traders. There's some really good traders out there, all right? But some of them have done some things that are just for branding purposes. And I told the class this last week. Fair value gaps, if you talk to the bank, smart money concepts, these type of things, that's not something that the banks even talk about. All right. That's like ICT, and some of those guys are using these things, and that's fine. There's nothing wrong with it. The principle is right. The name is just something that they've branded so that they can, push it on and make money from it, which is great. More power to them. Nothing wrong with that. What I'm telling you is be careful that we don't get caught up in thinking or being trained that a concept is some proprietary thing that somebody created or somebody invented, when really it's just supply and demand, and they've branded it in such a way where, they kind of claim proprietary knowledge, right? When really it's not proprietary, it's just supply and demand. All we really need to do is just look on the charts and find if there is supply or demand in the market. And when we see these gaps, these fair value gaps, which the banks don't call them fair value gaps, they call them hidden gaps. When we see these hidden gaps in the market, we need to be prepared to take a look at them, and just so we know where the likely retest areas are. Why? Because a fair value gap that happens in a bullish market is typically because there is more demand being created. A fair value gap that happens in a bearish market happens typically because there is more supply in the market than what they originally had, because orders are coming in as the market moves. The market doesn't stop moving and stop taking orders just because one order came in. Just because there's a big push for GBP does not mean that the banks say, all right, guys, we can't take any more GBP. We have too much GBP currency. We cannot take any more. What happens is they just fill the orders, and as the accumulation of supply happens, they let people know we have a lot. There's an abundance. And so they drop the price so that people will buy it because there's an abundance. And because there's an abundance, they drop the price so that others can afford it. Okay? Does that make sense to everybody? Awesome. So, with that being said, how do we actually trade it? Let's look at it on the candles. We got just a few more minutes. I wanted to make sure that we all understand this, okay? The gaps on different time frames vary. Are you basing these moves on the 30? No, they work on every time frame, Nabila. And so what you want to do is you want to stick to your top-down analysis. What you want to do is you want to say, okay, let's say the gap happens on the 4-hour chart. We're not going to enter on the 4-hour chart. what we're going to do is we're going to see the gap on the 4-hour, and then we're going to mark up that area. We're going to see where that actually, how that plays out on the 4-hour. And then we're going to come down to like the 30-minute for our levels, our highs, lows, all that, find our golden zones, find all that kind of stuff. And then we're probably going to enter on the 15-minute chart. For me, I like to enter on the 15-minute chart. Breakout entries typically happen on the 30-minute. Retest entries typically happen on the 15-minute. And so because by nature, a fair value gap entry is a retest entry, I want to see that happen on the 15-minute chart. So if this, what you're looking at on the screen, is a 4-hour chart, what I'm going to do is I'm going to mark that area out real nice. I'm going to mark that area out, and then I'm going to drop down to the 15-minute chart and watch it play out. And as price comes back down to it, all of this is fine and good. That's all good. But what I'm looking for is where it happens here. So now I'm on the 15-minute chart, and I start seeing this thing come into this area, right? So let's just say I'm on the 15-minute chart. Price is moving, and then I see this happen. And when I get here, I start to see rejection. Well, now I'm like, yeah, this is easy money right here. So I know that the area right here, right, is looking great. I see a rejection happening on a 15-minute chart. That's a great area to get in. Right? So does that make sense, Nabila? Now, let me give you one more tip. One more tip before we kind of jump into these candlesticks. When you see this happen, remember, the gap is filled when it gets down and fills the gap. Right? So when you see this happen and you start to see rejection here, is that gap filled? Right. So what is this? What does that mean? It means that there was enough demand in here that when price pushed back down, there was so much demand, and there's more demand coming into the market while this is happening. So that means that the sentiment of the market is stronger and stronger. So what happens is this pushes out, comes back down, and fills it out again. So now we get a nice move to the upside. It pushes back down. And then what will happen is this move will come back up, but it will typically mean that the move is over. Why? Because the demand is now exhausted. Does that make sense? So be aware of where the price is coming to. If it comes down to here, and starts showing rejection, that's cool. That's fine. That just means that that's over. This gap is done. This is no longer a valid fair value gap. It's filled. The gap is filled. Orders are satisfied. There are no more orders left from this gap. Boom. Pushes up, pushes down, whatever. But if it comes down and does not fill the gap, there's still orders in there. Okay? So now, so look at this. Now, sometimes you got to be careful that we're not looking at news candles. Like this right here was news, right? You go look at that. That was news. This was 8 a.m. on Tuesday. This was news. All right. This was not a normal, this is not a fair value gap. This is news that moves the market that way. All right. Now, let's look at this one. Oh, okay. So we see price moving up. We see the change in direction. All right. Let me grab my annotation here. We see the market move up, right? We see our rally base drop. Oh, man, I'm sorry. I'm messing up the sanitation. Boom. We get our drop. Boom. We see it retest off that wick right there. That wick tells a big story. We see volume. We see supply created. So we know that there's a move coming. A normal setup, what would we do with that supply setup? In a normal setup, we would take and we would mark out the top. Let me make that a little smaller. We would mark out the top. We would mark out the bottom. And we would say, look, price is going to push down. However, in this particular case, this wick right here pushes all the way to the top before it pushes back down. So what we need to do is we need to say, we're not really concerned with this being like a supply area. What we're really looking at this point is we are looking at the gap. So what happens here is, let me grab this annotation again. Price moves down, and there's where the previous candle closed. Price moves down, and that's where the next candle opens. So we have what we call a hidden gap. All right. So we do the same thing with this gap that we would any other time. We go from here to the bottom and we drag it over just like that. That is how we would look at this gap. We just box it up like we do any other supply and demand move. That's it. Nothing special. Price continues to push down. Now, is this also a fair value gap? Well, no, not really. What it is it's showing the strength of the market. Now, if we wanted to, you could say, well, man, until here, that's the fair value gap. That's a good point to make. What we need to understand is that just like wave theory, like we talked about earlier, how there are moves inside of moves, how there are waves inside of waves. The same way, we have to understand that orders are being filled while orders are being filled, right? So what we need to understand here is that the same way that one was created, we could come down here and look at this. I'm going to change the color so you can see it better. Okay? And we can say the satisfied orders are here. The remaining orders are here. There we go. There's the light bulb. There's the light bulb. Anybody see the light bulb come on yet? The satisfied orders are happening right here. But because we saw such a strong push down, we can go up to here and we would look at this. Good point. Thank you, Nabila. We look at this and we have it go all the way down like this. Good point. Watch this. Look at that 4 hour. Look at that 4 hour. Boom to boom on the 4 hour. Look at that. Right? So that's a beautiful, beautiful point to make. I'm looking at the 1 hour here. So we could come down here. I like narrower zones. So we could keep the 4 hour. Doesn't matter. One or the other. It really doesn't matter. So here's the 1 hour. We have our satisfied area and we have our batched area. So price moves down. We create a demand right here. Price pushes back up into the area. There's your big move. There's your big move. So if you are a conservative trader, you don't like risk. You just like to wait. You see the big engulfing candle. You come back here behind structure. You come to here at minimum right here at your structure. And you have a 1.75 risk to reward. Not quite 2 like I like, but it's still really good. But if you're an aggressive trader, you see the hammer right here. And you're like, man, this thing broke out. This thing broke out. Boom, I'm done. Now you got a beautiful risk to reward. However, this is happening on the 1 hour chart. So you're not going to trade it on the 1 hour. What you're going to do is you're going to see that happening, that candle forming, and you're going to drop down here. You're going to drop down here. Rally. You got this little base in here. There's your push. There you're in. Wrong one. Come back behind structure. You could take it down to the bottom, or you could take it down to the structure. For me, I would like this. I would come in here and I would find the structure. There's my take profit one. As it breaks out of this box, I'm moving my stop loss into profit, and I'm going to target this bottom area. And as it continues to move, I'm moving my stop in tight. Boom. That's it. And that's how you would trade that one. You don't do it on the 4 hour. You don't do it on the 1 hour. You come down to the 15-minute. Now, you see this right here is these satisfied orders. Real beautiful setup. As you see it approach this area of structure, look what happens. You get back into this area right here, and there you go. It pushes past, it retests right at that structure, and then volume comes back in. Because just like I said earlier, you're going to have where it comes down, high, low, lower high, and it is going to test that area there to see, is this going to be a lower low, or is price going to reject and go higher? In this case, it got down here to this lower low, it retested and broke. So we created a high, low, lower high, lower low. Now, once we created that, what's happening now? Now, you know good and well that you still have a big area up here from this gap. So what's going to happen? It's likely going to come back up. Well, here it didn't come back up. So is this area filled yet? No. So look, it ain't that hard. Watch this. Uh-oh. Uh-oh. Could it be? Could it be? The pattern on the 15 carries it back to our zone, dumps off the supply, and then continues with the original market sentiment. Overall, making this simple from way back. Watch. Ready? Making this really, really simple. All of that fancy stuff. Gap, supply, dump off, big possible teacup. Really, what's happening? It's really just super simple. Watch this. Low, high, higher low, higher high. That's it. That's it. It's really not all that crazy. It's just looking at how the current market is moving so that we can know the character of the market. Or as Nick Jones says, the whole vibe. I love that, Nick. You know you done gave me a new way to call this now. Does that make sense to everybody? We just got to bring it down to simplistic terms. We try to overcomplicate things. We're trying to make things like, oh, I got to be the master. I got to be the guru. Man, we don't need to be the guru. What we just need to be is profitable. I just need to know, what is the overall market condition? Not just are we bullish or bearish, but how does the market move? Well, watch this. Look back. Look back. How do you see this market moving? Right? How do you see this market moving? What I see is that every time we get to an area, the market likes to move sideways for a little bit. What do you see? That's what I see when I see the sentiment of the market. right? So let's pull it forward. We see the big push. What do I see? Higher time frame. That's it. All I'm seeing is a big push and then coming down to come and get back into this area so that we can push to the upside. That's all. Because the market sentiment tells us so. Does that make sense to everybody? So that's it. That's what I want. I want you to focus this week. TGP members, what I want you to do is I want you to focus on last week's video and this week's video. I want you to take these two videos where I'm teaching you about the hidden gap. But I want you to take that and I want you to go back to the order of operations teaching. I want you to incorporate this into your Forex order of operations. And then next week, guess what I'm going to do? Because I know, we don't have, I can't do everything in one class. Next week, what I'm going to do in class is I'm going to take it to the next level. First week, I taught you what fair value gaps, what hidden gaps were. This week, I'm taking it further and giving you the understanding of the overall market sentiment and how batched versus satisfied orders move the market. Next week, I'm coming and I'm bringing to you how do the Fibonacci, how do the fib levels work in conjunction with, with these gaps and how supply and demand can be read off of your fib levels. Is it more important that we see a fair value gap at a golden zone or at a low or like a 0 to 12, 100 to 78? Which one do we want to see a fair value gap at? We're going to talk about that next week. I'm going to show you how we can drop the fibs out there and see exactly where we want to have these things happen. All right. So if this brought you value, guys, because I know a lot of people are watching from YouTube. I know we've got people watching on YouTube live right now. There's some, I don't know if there's anybody here tonight in the Zoom room that is not typically a part of TGP. I'm glad you got to be part of it. I hope that this giving back for Thanksgiving was a blessing to you. I hope that I can help you, and I hope this brought you value. And so definitely glad you were here tonight, whether on YouTube or whether you're watching the recording later or whether you joined in the room tonight. I just want to say happy Thanksgiving. And I hope that my attempt to give back to you actually gave you some value. The second thing is this. Don't miss out. You need to jump on board. Come into TGP. Come into TGP. I'm telling you right now, the classes are insane. The trade setups are winning consistently. Like we're winning together. TGP people. I mean, just drop me a little comment here. What are we doing here? What are we doing here? Are we winning? Are we winning together or what? Are we killing this or what? You know what I'm saying? So, I mean, guys, just read the comments. That's all I got to say. Let the haters hate and just read the comments. That's all I need to tell you. Jared said he got 124 pips last week. Boom. 124. Oh, in one day. Caught 124 pips last week in one day. Jared, he said, we rolling. Somebody said, let me see, just join, just try it out, get serious, you'll grow. Skylar said, we're winning together. Edward Daffin said, we're eating. Guys, look, we're winning together. We're winning together. So, look, I don't know what you're waiting on. Go to tradinggetpaid.com. All right, go to tradinggetpaid.com. Links in the description. Join today. Don't waste any more time. Let me help you become a professional trader. I'm not trying to help you try to become some guru. That's not my, I'm trying to help you become a profitable and professional trader, right? I'm not here to impress you. I'm not here to build a brand. I'm not here to try to, entertain you and all that kind of nonsense. I'm trying to educate over entertain. Education over entertainment. That's what we do out here. All right. So that's it. That's it. Tootie said, 1-1-1-1. We are over 90% win rate. Yeah, over 90%. Find me another one that's out here doing 90%, man. Come on. So if you're serious about being a trader, that's what Michael said. If you're serious about being a trader, you got to join today. Coyote said, Joe is as real as it gets. I appreciate you, my brother. Stop following the flashy. I feel you on that. Skylar said, you learn the why behind stuff and helps you overall better in your trading. Facts. Nick Jones said, best value out here. Guys, thank you, TGP members. I'm just saying, I could read comments all night long. Go on my YouTube. Look, if you like what you're seeing on YouTube and you like the free content I'm getting, you see what we did tonight. Ain't nobody else out here giving that game. Join today and let's eat. Everybody have a great Thanksgiving. TGP, we're going to eat this week. There will be no trading on Wednesday night and Thursday night because it is Thanksgiving. But I appreciate you guys. Skylar said, Joe is honest and wants you to succeed. If you put in the work, you'll win. Absolutely, man. Appreciate you guys. God bless. I love you, man. And we'll see you guys next Monday in class in the community this week. Have a great week. God bless.